A 73-year-old retired man walked into the exact same local bank branch he had used for 30 years. He asked to withdraw $5,000 of his own money to pay a roofing contractor. Instead of handing him the cash, the teller looked at her screen, made a phone call, and completely froze his account. For the next 14 days, he could not pay his electric bill. He could not buy his weekly groceries. He could not touch a single dollar of his own retirement savings. And here is the part that should make you sit up and pay attention. He did absolutely nothing wrong. It wasn't a mistake. There was no scam. The bank froze his money on purpose, and under a set of rules quietly rolling out across the country, they were completely allowed to do it. If you were born before 1963, you have quietly been moved into a new legal category. It affects your bank account, your property taxes, your social security check, and your medical bills. I am David Taylor from Senior Money Brief. And today, I am going to walk you through 5 specific financial rules that just changed for older Americans. More importantly, I am going to give you the exact forms and phone calls you need to protect your money. Because here is the hard truth nobody tells you. Being legally protected from a financial trap and actually keeping your money are 2 completely different things. The system will take your money automatically, but it will never automatically refund you. The bridge between losing your money and keeping it is a single piece of paper they will never mail you. Let's start with the bank freeze, because this is happening right now, and the fix is completely free. For decades, if a bank suspected an older customer was being scammed, their hands were mostly tied. They could warn you, but if they held your money and were wrong, you could sue them, so they let the money move. But elder fraud has exploded into a billion-dollar problem. So lawmakers decided banks needed more power to step in. They passed what are called safe harbor laws. As of right now, more than half of all U.S. states have one. Here is what a safe harbor law does in plain English. It says that if a bank's computer system reasonably suspects a customer over the age of 65 is being financially exploited, the bank can freeze the account. They can hold your money, block your transfers, and lock you out for up to 15 business days while they investigate. And you cannot hold them legally responsible for the delay. 15 business days means weekends and holidays do not count. That can stretch into 3 full weeks without access to your own money. The intention behind the law is good. It is meant to stop a widow from wiring her life savings to a romance scammer. But here is the trap for the honest senior living a normal life. The bank does not have a human being watching your account. They use artificial intelligence. They use algorithms to learn the normal rhythm of your spending. And the moment you break that rhythm, the computer throws a red flag. What trips the wire? Buying a new iPad and logging into your account from a different device. Using Zelle or Venmo for the very first time to send money to a grandchild. Withdrawing a large chunk of cash to buy a used car or fix your home. To the computer, that does not look like a grandfather fixing his roof. It looks like a scammer draining an account. So, the freeze drops. But here is exactly how you bypass the algorithm and protect your access. It is a free tool called a trusted contact. Almost every major bank now allows you to name a trusted contact on your account. It is usually a son, a daughter, or a close friend. A trusted contact cannot see your balance. They cannot spend your money. All they can do is answer the phone when the bank calls to ask if you are okay. If that 73-year-old man had a trusted contact on file, the bank would have made one phone call to his daughter. She would have said, "Yes, Dad is getting his roof fixed. That is perfectly normal." The computer would be satisfied, and the freeze never happens. Call your bank this week and ask to add a trusted contact. It takes 5 minutes. Now, a bank freeze is loud and terrifying, but the second rule change on this list is completely silent. It is happening right inside your mailbox, and it controls the single biggest recurring bill you pay on a home you already own. Let's talk about your property tax bill. For most retirees, this is the single heaviest financial weight they carry. You pay off your mortgage, you think you finally own your home free and clear, and then the county reminds you that you are really just renting it from the local government. Over the last few years, home values across the country have exploded. You might be sitting in a house that doubled in value without you doing a single thing to it. And what does the county do? They assess your home at that new inflated number, and your property tax bill climbs right along with it. Your retirement income is fixed, but your tax bill is definitely not. But here is the rule the counties desperately hope you never find out about. In a large number of states, the day you turn 65, you legally qualified for something called a senior assessment freeze, or a senior exemption. What this does is incredibly powerful. When you file this specific piece of paper, the county locks in your home's taxable value at whatever it was the year you applied. From that day forward, it does not matter how much your neighborhood gentrifies. It does not matter if the houses on your street start selling for double what they used to. Your tax bill is calculated on your frozen number. Your home's value can skyrocket, but your tax bill stays put. So why are millions of older Americans in their 70s and 80s still paying full, rising property taxes every single year? Because of the trap. Being legally entitled to a freeze and actually getting it are two completely different things. This protection is not automatic. The county will never proactively mail you the application on your 65th birthday to congratulate you. And the reason why is brutally simple. Your county tax assessor's office is funded by the exact taxes they collect from you. Every dollar of exemption they hand out to a senior is a dollar their own local government does not get to spend next year. They have zero incentive to remind you to stop paying them. If you are 65 or older and own your home, do this tomorrow morning. Call your county assessor's office. Ask them two specific questions. Do you offer a senior assessment freeze or an over 65 exemption? And, which form do I need to file to put it on my record? That is a 5-minute phone call that can save you tens of thousands of dollars over the rest of your life. Stopping the local county from quietly overcharging you is step one, but the federal government just created a brand new way for you to keep thousands more, and your own tax preparer probably won't even mention it. Now let's look at your federal taxes. Out of all the rules we are covering today, this is the one that feels the most like finding hidden treasure. Buried inside the massive federal tax changes that recently rolled out, lawmakers quietly created something specifically for older Americans. It is being called the Senior Bonus Deduction, and it is worth up to $6,000 per person. I want to be incredibly precise here, because even professional tax preparers are rushing right past this. This is not the regular standard deduction that everybody gets. This is a brand new extra deduction stacked directly on top of it. If you are 65 or older, you can legally knock an additional $6,000 off your taxable income. If you are married and both of you are over 65, that is $12,000 of your income completely shielded from the IRS. For a retiree living on a modest fixed income, shielding $12,000 means a massive chunk of your tax bill simply vanishes. For many of you, it means you will owe the federal government absolutely nothing at all. But here is the catch that costs people dearly. The IRS does not automatically apply this bonus to your return. The system assumes that if you don't ask for it, you don't want it. If you use a basic tax software and you accidentally skip past the specific question about your birth date or senior status, the software leaves the $6,000 on the table. If you hand your paperwork to a hurried accountant who is processing 50 returns a day, they might just copy last year's standard deduction and hit submit. The IRS accepts the return, keeps your extra money, and never sends you a letter explaining your mistake. The action here is simple, but you have to be the one to enforce it. The next time you sit down to file your taxes, or the next time you review the paperwork your accountant prepared, stop before you sign. Look them in the eye and ask, did you apply the new senior bonus deduction? Look for that extra $6,000 line item. If it is not there, do not sign the return until they fix it. Shielding your income from the IRS is huge, but keeping your money does not matter if your pharmacy simply takes it all back. Which brings us to the new rule hitting your health costs. For a lot of older Americans, the scariest bill in the mailbox isn't the taxes. It is the cost of simply staying alive. Medical costs drain retirement accounts faster than anything else. But right now, two massive rules have changed in your favor. The first puts a hard, legal ceiling on your medications. For years, the cruelest part of Medicare Part D was that there was no real upper limit. If you needed an expensive specialty drug, you just had to keep paying, month after month. People were literally splitting their pills in half to make the bottle last. That ends now. Federal law has placed a strict out-of-pocket cap on covered prescription drugs. For 2026, that cap is exactly $2,100. Here is what that means in the real world. Every dollar you spend out of your own pocket on covered medicine counts toward that ceiling. Once you hit $2,100, you are done. Your plan picks up 100% of the cost for the rest of the year. Whether it is a basic daily pill or a highly expensive specialty medication, once you cross that line, you pay absolutely nothing at the pharmacy counter until January. That cap is automatic. But the second health rule requires you to raise your hand. and it targets the money quietly disappearing from your Social Security check every single month. If you are on Medicare, you pay a Part B premium. In 2026, that premium is over $200 a month. It gets pulled straight out of your Social Security check before the money ever hits your bank account. That is over $2,400 a year gone. But here is the secret. There is a government program called the Medicare Savings Program. If your income qualifies, your state will step in and pay that Part B premium for you. They do not lower it. They pay it entirely. When the state pays that premium, those $200 stop coming out of your Social Security. Your monthly check immediately goes up by that exact amount. Here is the tragedy. Millions of seniors who legally qualify for this program never apply. Why? Because they assume it is only for people living in deep poverty. They look at their modest fixed income and tell themselves, "I make too much." Do not disqualify yourself at your own kitchen table. The income limits are much higher than most people assume. In many states, your savings and your paid-off house do not even count against you anymore. Call your local SHIP office, that stands for State Health Insurance Assistance Program. Ask them to screen you for the Medicare Savings Program. It is a free call that takes 10 minutes. Getting that Part B premium put back into your Social Security check feels like a raise. But wait until you see the decades-old error that is actively shrinking the rest of your check. Let me ask you a question. Do you know exactly how the government calculated the Social Security check you are receiving right now? Most people assume it is based on their last few years before retirement, or maybe just a general average of their final salary. That is completely wrong. The Social Security Administration calculates your monthly check using a very specific formula. They look at your entire working life, and they pull out your 35 highest earning years. They average those 35 years together, and that lifetime average dictates exactly how much money you get every single month. That 35-year average is the most important mathematical number in your retirement. But here is the terrifying part. What happens if the data they used is wrong? Think back to the 1980s or 1990s. Did you ever work for a small local business where the owner did the payroll by hand? Did you ever work as an independent contractor? Most importantly, did you ever change your last name after getting married or divorced? If you changed your name, and your employer reported your earnings under a name that didn't perfectly match your Social Security file, those earnings never attach to your record. They are just floating out in the system, credited to no one. When Social Security goes to calculate your top 35 years, and they can't find those missing earnings, they do not call you to ask what happened. They simply plug in a 0 for that year. Those zeros go straight into your formula and drag your entire lifetime average down like an anchor. According to the government's own estimates, a single missing year of earnings can shrink your monthly check by roughly $100. That is $1,200 every single year. Over a normal 20-year retirement, one single typo made by a payroll clerk 30 years ago could quietly cost you $24,000. And nobody is going to fix it for you. There is no automatic audit, there is no warning light. You have to go find the error yourself. You do this by going to the official government website, ssa.gov, and pulling up your free Social Security statement. Look closely at the section called Your Earnings Record. It lists every single year you ever worked. Scan that list line by line. If you see a year that shows a 0, or a number far lower than what you know you actually made, you have caught the trap. You fix it by filing a specific form called a Request for Correction of Earnings Record. You provide your proof, they fix the data, and your monthly check gets recalculated. It is not a one-time refund. It is a permanent raise for the rest of your life, simply because you finally forced them to count the money you already earned. Now you know the 5 traps. Here is the exact, step-by-step checklist to fix them all this week without paying anyone a dime. Now that you see the traps, let's close them. I am going to give you your 48-hour action plan. Do not put this off until next month. Make these moves this week, and you will lock down your money. First, call the bank where you keep your retirement savings. Tell them you want to add a trusted contact to your profile. Give them the name and phone number of your son, your daughter, or a trusted friend. That one 5-minute phone call builds a wall between your money and the computer algorithm trying to freeze it. Second, call your county tax assessor. Do not assume your property taxes are fine just because you pay them on time. Ask them directly, do you have a senior assessment freeze or an over 65 property tax exemption on file for my home? If they say no, ask them which specific form you need to file to get it. Let the county absorb the cost of inflation, not your retirement account. Third, pick up the phone and dial your local SHIP office, the State Health Insurance Assistance Program. Tell them you want to be screened for the Medicare Savings Program. Let them run your actual numbers to see if your state will wipe out that $200 Part B premium. And finally, the next time you sit down to file your taxes, do not let your preparer rush you out the door. Force them to verify that the new $6,000 senior bonus deduction is actively written onto your federal return. Every single one of these moves is completely free. You do not need to hire a lawyer to do this. You just have to be willing to ask the right questions. Here is the final truth about everything we just covered today. The financial system in this country relies quietly on your silence. The county, the IRS, and the banks are not going to knock on your door to hand back the money you overpaid. They will happily let you go your entire retirement, leaving thousands of dollars on the table if you let them. The only person who is going to build a fence around your money is you. Now, one quick reminder. This video is for general education, not personal legal or tax advice. These rules can vary depending on your specific state and income, so always confirm your own numbers with the right local office or a qualified professional before you make a move. But do not let that stop you from making the calls. If this video opened your eyes, do one thing for me today. Send it to one person you love who is over 65. There is a very good chance they are paying a bill right now that they are legally exempt from, and the system is never going to tell them. You might be the only one who does. I am David Taylor from Senior Money Brief. Subscribe and turn on the bell so the next alert finds you. I will see you in the next video.